In this week's video, we'll look to the charts to help us answer the question, is the evidence beginning to lean bullish for stocks? To view the video in full screen mode, use this icon in the lower right-hand corner of your video player. To improve the clarity of the charts, use this icon in the lower right-hand corner of your video player. This is a daily chart of the S&P 500 index as of the close on Friday, September 11th. 2 quick points. It's possible the bulls may be their own worst enemy relative to the Fed. The Fed recently said, if you read between the lines, we want to raise interest rates, but we're a little concerned about recent market volatility. Well, volatility has calmed down. If we head into the Fed meeting and the S&P 500 is in this area here, it probably increases the odds of either seeing an interest rate hike or getting a hawkish statement. If we remain in this general area, probably won't have too much impact, and the lower we go, especially if we make a lower low before the Fed meeting, it probably lowers the odds of a rate increase or a hawkish statement. One more point. Even under the most bearish scenarios, it is possible that the S&P 500 would go back and retest this area here at 2040. This is an easy area for the bulls to retake all the way back up above 2040. Mathematically, it probably wouldn't change much from a trend perspective. Obviously, we'll look at the evidence at that point. But we have to be mentally prepared for a move back to 2040, and then the shorts could come in here possibly. These are hypothetical scenarios, and stocks could fall and then go on to make a new low. If the S&P 500 gets up into this area, what will we do? We will do what we always do. We will review the evidence and look at the models relative to our allocations, and if we need to make adjustments, we will make them. I think you'll find in this week's video not much commentary is needed relative to the charts. They'll do the talking for themselves. We've looked at these charts in the past to help make the bullish case. This is risk on relative to risk off, S&P 500 relative to a diversified basket of bonds. This is what the dot-com peak looked like in the year 2000. The S&P 500 peaks here, and you can see the ratio moves to a full-bore bearish look with the ratio below both moving averages and blue below red, and the slopes of both are down. Similar situation. 2007, the stock market peaks here, and then the monthly risk-on, risk-off ratio moves to a full-bore bearish look with price below both moving averages, blue below red, and the slopes of both are down. How does the exact same chart look today? The answer is very similar to these rollover periods where the S&P 500 peaked. You can see in the spring, this chart and ratio looked much, much better. 2 important caveats. Number one, a relatively minor one. This is as of the close on September 10th, which would be Thursday, since this is a mutual fund and it hasn't settled yet, so this chart could be a little bit different. The one that's more important is it's only September 11th today. This is a monthly chart, so it has 3 weeks or so to potentially improve. Right now, it's telling us to respect the bearish case. Similar concepts here, except now we're looking at risk-off bonds relative to risk-on stocks. Another significant exception is these are now weekly charts, not monthly charts. IEF relative to SPY. What can we learn here? The S&P 500 bottoms right here in March of 2009. So this is the beginning of a risk-on look or favorable look for stocks. You can see the ratio is below all of the moving averages, and the slopes of all of the moving averages are down as the S&P 500 bottoms. So this is a bullish look. Here is the look when the stock market bottomed in 2011. Stocks actually bottom here and they start to trend strongly heading into 2012. Similar situation. The slopes are rolling over and the ratio is below the moving averages. And this is a full bore bullish look in favor of stocks. Ratio below all the moving averages and the slopes are down. Do we have a similar bullish look for the stock market relative to these looks here? Which is another way of saying, how does the exact same ratio look today? The answer is, it really looks nothing like these bullish periods. We said we wanted the ratio to be below the moving averages and the slopes of the moving averages to be down. We have just the opposite. We have the ratio above the moving averages. The fastest moving average, blue, is on top and the slopes are up. This doesn't look anything like this transition period yet in 2011. It should be noted, this doesn't really have any predictive validity relative to when the news will change, meaning it's possible that we're right here and things are about to change. But under our system, we wait for the evidence to start to change. So right now, this chart is saying on a weekly basis, the probability of good things happening in IEF, or intermediate term treasury bonds, relative to SPY is favorable. This is a full bore bullish look in favor of owning bonds over stocks. This chart is making a probabilistic forecast given the information as of September 10th. If we fast forward one day to the close on Friday, September 11th, you can see we get the same full bore bullish look in favor of bonds relative to stocks. Same concepts. Now we're looking at what does this chart look like when the stock market peaks. Here in 2007, the stock market peaks in October. Soon thereafter, this ratio goes to a full bore bullish look in favor of owning defensive bonds over growth-oriented stocks. This is an observable shift. We can see it. We can measure it. 2011, stocks began to peak in early May, but didn't plummet until early August. Here, as the market's peaking, you can see the ratio is above all of the moving averages and the slopes start to turn up. And before we hit August, we get a full bore bullish look in favor of owning defensive bonds relative to growth-oriented stocks. You don't want to be in stocks in this period here. It's a poor risk-reward period to own stocks. How does the exact same ratio look today? Does it look like these bearish periods for stocks? The answer is yes. It looks very similar. The ratio is above all the moving averages, as it was here, and the slopes of all of the moving averages are up, which looks very similar to these peaking periods for stocks. Does this mean that Armageddon is ahead of us? No, it doesn't mean that at all. What it means is putting our capital in harm's way here offers a poor risk-reward ratio. What it says is we want to see observable improvement on this chart, and then we are happy to begin to feather our capital back in. What this chart does tell us too is, as of the close on September 11th, the market's probabilistic forecast, looking out weeks and months, is leaning towards owning defensive-oriented bonds over growth-oriented stocks. That forecast is subject to change when the inputs change. But we can see this, we can measure it, and right now it looks favorable for bonds looking out weeks and months. The CCM market model looks at the market from two different perspectives. One is the master market model, and then we have the ETF scoring system that follows and ranks literally hundreds of ETFs. Now we're looking at risk off relative to energy stocks. This is what a bullish look looks like for the stock market. Here you can see as the stock market bottoms in early March of 2009, as that happens, the ratio is below all of the moving averages and the slopes of all of them are down. This is a risk-on look, a favorable risk-reward ratio look for equities over bonds. In 2011, the stock market started a bottoming process in October and really began to trend in early 2012 in favor of equities. You can see here the ratio starts to gravitate around the moving averages, and the moving averages start to roll over. So when we get to the very favorable period for stocks, which is early 2012, stocks rally for several months from this point here. We have the ratio below all of the moving averages, and the moving averages are rolling over. So this look here is similar to this look here. Do we have a bullish setup forming for the stock market? Meaning, does this chart in the present day look like this or this? This is the exact same ratio using the exact same moving averages as of 10:18 a.m. on Friday, September 11th. This chart did not change materially between 10 a.m. and the close. This is the look that we would like to see to turn bullish for equities. This is the look that we would like to see where the odds are in our favor. The present day look doesn't look anything like that. It could begin to turn next week, but we need to see it. As we discussed in last week's video, to avoid curve fitting and building a model that fits nicely into the data that we used to study and build the model, the market model diversifies and uses numerous inputs and numerous moving averages. Similar concepts here. We've taken price out so we can focus on trends. A full bore bullish look is when blue, the fastest moving average, is on top and the slopes are all up. You can see in November of 2007, a big yellow flag starts to wave about the risk-reward ratio for equities. 2008 is not a good time to own equities. So this is a yellow flag, red flag here. How did this chart look in April of this year? The answer is much better. And you may recall in the videos in April of this year, we said that we had some time to be patient with stocks relative to the market's risk-reward profile. This is a decent risk-reward profile here, and this is a favorable risk-reward profile. Has this chart, this daily chart, changed significantly since April? The answer is yes. Here in November of 2007, the stock market's peaking here and the bear market has started. This is when the yellow/red flags start waving faster with a full bore bearish look, with blue the fastest moving average on the bottom. We have that now. Notice the slope of this here. This is actually more bearish than this slope in the short run. Why? This is a sustainable trend. This is a market that fell out of bed, and typically when you get something like this, it's not sustainable. And what this tells us is, it's not a bullish look, but it tells us the probability of a bounce back rally remains high when you fall off the table like that. So we have to be prepared for the stock market to right itself in the short run, especially between Monday and the Fed announcement, and rally back up into this area. None of that represents a prediction about anything. We'll keep an open mind. The only thing we know with 100% certainty, this was an unfavorable period for stocks. This is an unfavorable look from a risk-reward perspective, regardless of if the stock market goes up next week. We do not want to put our capital in harm's way when the odds are this unfavorable. As we said, the market model is highly diversified. These are moving average pairs, one set of many used by the market model. Regular viewers know that this is a full bore bearish look with price below both moving averages, blue below red, and the slopes of both are down. And this is what a bullish look looks like in early 2009. This is a favorable risk-reward look. How does the exact same chart look today on the exact same time frame using the same weekly moving averages? While the bulls did get a bounce this week, the S&P 500 was up 39 points. If I recall, it was down 67 points last week, and this is what a downtrend looks like. We moved up this week, but we still have a full bore bearish look. This looks a lot more like this. Really doesn't look anything like this. We want to see a turn like this, and look how early the turn takes place. We can wait to see the evidence turn and put our capital in harm's way when the odds are more favorable. This market here could easily rally back to 1995 on a weekly basis, and then you could see 2050. Psychologically, we have to be prepared for that. If that does happen, we don't do anything differently. We just simply look at the hard data and ask, are we allocated properly? Same concepts, we're just using longer duration moving averages. This is the look we prefer to avoid. This is the type of look that we want to participate in. The present day look as of the close on Friday, September 11th still looks like a look that we do not want to participate in. You can also see here that rallying back to the moving averages at some point is very realistic. So to see a move back to 202, 204, 206, even up to 208 would not be unheard of in SPY, even under retest and fail bearish scenarios. These are weekly charts here, and they're concerning, and they need to change. They may change beginning next week, but right now they don't look good. This is DOG, or shorting the Dow relative to owning the S&P 500. This is a full bore bearish look in favor of shorting the Dow. This is a full bore bearish look in favor of shorting small caps relative to SPY. And this is a generic basket of bonds relative to a broad basket of stocks. It has a full bore bullish look in favor of owning bonds. Similar concepts. Let's assume you didn't know what this symbol was, and this was X relative to the S&P 500, and I asked you, which would you prefer to own, the numerator or the denominator? You wouldn't hesitate. You'd say, I'd prefer to own the numerator since it has a full bore bullish look on a weekly chart. Well, what does it tell us when shorting the S&P 500 is clearly more favorable from a probability perspective than being long, especially in a longer term look? Doesn't mean we can't come back down and retest, but right now this is telling us that the odds are not in our favor, and we prefer to protect capital until this chart improves. Treasury inflation protected securities, bonds relative to stocks, it favors bonds. Shorting technology stocks relative to owning the S&P 500, it favors shorting technology stocks as of 3:14 p.m. on Friday, September 11th. This is a daily chart of SPY, or the S&P 500 ETF, that we've shown on Twitter numerous times. If you just watch these videos, you might want to bookmark our Twitter feed. You don't have to be on Twitter, know anything about Twitter, have an account, or particularly like Twitter to bookmark the page and to use the links. These are Fibonacci retracement levels here. We've stalled around the 50% retracement. We've got the 61.8 at 201 and change. It would not be unusual to come back up and retest this bearish cross here. This is the 50-day, 200-day. This is telling us that the odds are now saying that the intermediate term trend is bearish and the longer term trend is now rolling over as well. We could come up and retest this. This chart, like many others, could begin to improve starting next week. But right now, there's very little here to get excited about from a bullish perspective. Similar concepts here. Now we're looking at the daily chart of the S&P 500 as of close on Friday, September 11th. One quick point. This is a band of resistance that we've been watching. If we break into this area here, it doesn't mean the bulls are home free. It basically means that now 2040 and this range, what once was support, may now act as resistance. What once was support may now act as resistance. So this is hurdle number 1, and this would be hurdle number 2. The bulls really make some progress if they can move into this area here, and more so if you can get up above 2100. That starts to really look like a significant move. As always, we'll head into next week with a flexible, unbiased, and open mind. The charts, the hard data, and the market model readings will guide us if we're willing to listen. How do we track all of this and convert it into a usable and actionable format in a reasonable amount of time? The submodels, we answer binary questions, some of them manually done, some of them programmed in Excel, and we also enter in unbiased and hard data. The submodels allow us to get a handle on the market's current profile, and the master CCM market model then looks at the current profile, compares it to past profiles, and recommends a prudent allocation between risk assets such as stocks and conservative assets such as bonds. Conservative assets can consist of cash, bonds, currencies, or any number of investment options. If you'd like to learn more about the market model or our money management services, you can visit our website, follow along on Twitter, Facebook, read our blog short takes, or watch past videos on the Shivako Capital channel on YouTube. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shivako Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.